Hello, this is Troy Eckard. I'm the CEO and manager of Eckard Enterprises in Dallas, Texas. Today I want to talk to you about where I see the oil and gas industry today, May of 2021. I'm not going to spend a lot of time recapping the last 14 to 16 months. It's kind of like looking at the history books. You know what happened, now we have to figure out what's going to occur going forward. Now, as most of you who follow me know, I'm pretty bold and I'm pretty forward in what I think and why I think the various items and elements and aspects that will affect the oil and gas industry and what's going to take place going forward. I've said for the last 14 months that we have an unusual event that's occurring in the oil and gas space I have not seen happen since I started my career in 1985. It is the withdrawal of capital. It is the enormous recoil that's taking place in the capital markets as it relates to further investments in the U.S. oil and gas space. What that means is that because of the political environment when it comes to the green energy, when it comes to the big push for EVs, electrical vehicles, when it comes to all the different necessary but also contrarian type of alternative energy sources, it is putting a negative impact on the oil and gas space. Now, what's that going to do for us as an industry, and what will that do for the American consumer? So let's mainly talk about the industry as a whole, and then the consumer will be a subsequent event as to what the industry is going to deal with. If you're an oil and gas company and you're trying to sell bonds, you're trying to secure debt, you're trying to get investors to buy your stocks, the stock price will rise, and there is enormous pressure, both regulatory and economic pressure, not to invest, not to participate in the economic thriving or growth of an industry like oil and gas, that particular industry is going to be starved of the necessary capital. Let's face it, the oil and gas industry is one of the largest capital-intensive industries of any industry out there. It takes a lot of money to drill wells, shoot seismic, lay pipeline, and put wells online and refine it. It's an expensive industry. If the current oil and gas market, which has already been lambasted over the last 14 months, finds itself deprived of those resources such as selling bonds or creating more lines of credit and securing additional debt, what will happen is it puts the supply side of our business in very, very tight constraints. It means these oil and gas companies will have to live and die and grow or not grow based on the cash flow from their current producing oil and gas wells. Here's the dilemma. Every oil and gas well produces less tomorrow than it did today. It's a diminishing return. From that standpoint, it means that if we're going to grow as an industry, how do you grow when the fact is you're pulling reserves out of the ground, selling those reserves for a lower quantity than what you produce today? There's only one solution. We must get paid more for the oil and gas we're selling to create higher cash flow, which allows us to then go and provide more exploration, provide more pipelines, provide more refineries. In other words, there's only one solution in a capital-deprived industry like oil and gas that literally has 100% utilization by every breathing human being in the United States. Every single day, every single American is using some form of a barrel of oil and gas. Okay? If that's true, and the capital will not provide the necessary means and resources to grow the industry, we're going to see our supply side shrink, capital infusion has ceased. There's only one solution to get additional supply. You must pay, the consumer must pay, a much, much higher price for a barrel of oil or an MCF of gas to create that free cash flow that allows these oil and gas companies to expand their exploration efforts. Now, I'm telling you today, in May of 2021, we are in one of the biggest jams we've been in my 35-year career. It could be worse than the oil embargo. It could be worse than the debacle in 2014. It might even be, in my view, much worse than the 2008 record prices that were paid for a barrel of crude oil at $145 a barrel. And here's why. Now that COVID seems to have been derailed, and now it looks like demand is back to pre-COVID demand ratios, supply is down 24%. We now see the fact that the drilling rig count is still less than half of where it was before COVID. The reality is starting to set in. We need 21 million barrels a day in the United States. We're producing about 11 million barrels a day. No matter how fast the current 400 plus rigs are drilling, the decline curve from older wells is dropping faster then we can drill new wells to replace it. We're in a losing proposition with regard to supply. When you further look at the cost of capital, what will it take for an energy company to secure new bonds or get investors to buy their stock or possibly get a line of credit? It's going to take a lot more than the cost of capital. They're not going to get it for 4 or 5%. They may have to pay 6, 7, 8, 10% interest rates in order to attract enough money to expand their business. All that goes into the underlying cost of a barrel of oil or the gas that's produced for your home. In my view, being in the business since 1985, this will be one of the fastest rising commodity prices and sustainable high prices of crude oil and natural gas I've seen in my career. It's my personal belief by the end of 2023, we will set new record highs for crude oil over $145 a barrel. It is my belief that natural gas has moved up $1 to $3 per thousand cubic feet in what I would consider to be a low-end value for natural gas, because a lot of gas has come offline as the oil wells have started lowering their production, and that gas has also come down because it's associated gas. The lack of drilling, the decline in wells, the increase in demand have all led to one simple conclusion. We will need a lot more oil and a lot more natural gas than the wellheads and the oil companies that are active today can supply. I think it's going to be further exacerbated by the $4 trillion dumped into the market. If the infrastructure plan is further added on top of government spending, we could see an enormous jump in demand for whatever might come with that infrastructure stimulus package. At the end of the day, I will tell you this, whether oil goes to $145 a barrel or merely goes between $80 and $100 a barrel, those of us that own producing oil and gas wells in this country, those of us that own mineral rights, those of us that have been smart enough to place into our investment portfolios the very key asset, which is oil and gas producing properties, will benefit enormously by the rise in commodity prices that are fully expected over the next 24 months. Now, how long will this last and what can happen in between now and then? Well, we've got the COVID India factor, which tells me essentially that we might have a big user or consumer coming off market to some degree over the next 6 months. We have Iran, who says they're going to be back online with 2 million barrels a day as a result of some of the sanctions being lifted. All that's been factored into the numbers. Quite frankly, today at $65 a barrel, we might see it drop back down to $59 or $58 a barrel over summer of 2021. But at the end of the day, it's my personal belief we will see oil prices settle on the last trading day of this year, 2021, north of $70 a barrel and most likely north of $75 a barrel. It is my also personal belief we will see oil prices close the end of 2022 north of $90 a barrel. $90 a barrel is setting the tone for what I realistically expect to be the price it takes to attract new capital to the market. The big difference for you and I is follows. Everything we invest in, from stocks, real estate, everything else we invest in is directly affected by rising energy prices. If those energy prices follow the pattern I believe they're going to follow, you're going to start seeing an erosion effect in the net operating income of real estate. Stock market companies, publicly traded companies will start seeing their transportation, electricity, labor, all those costs will start going up. And what we're going to see is a direct reflection of rising energy prices to a de minimis or at least a detrimental economic effect to other business sectors you may currently be invested in. Now, as an owner and as a major buyer of mineral rights in the state of Oklahoma, the one way we can prevent this or we can participate in the upside is by moving today to buy cash flowing de-risked mineral rights. How do we do that? Well, we find where the most successful and smartest oil companies are permitting and drilling wells. We use technical prowess to come in and identify sellers who need to sell mineral rights in those key areas today because of liquidity factors, secure those mineral rights, and sit back and enjoy the uplift in value that I believe is going to occur dramatically over the next 24 to 48 months. Now, the reason I do videos like this is I think many of you probably are aware that we're in an inflationary period, probably aware that inflation could be rampant, double-digit within the next 6 months, and most likely aware that rising energy prices will affect most of your portfolio. What I generally find in dealing with high net worth investors is they never put the pieces of the puzzle together. They never tie the strings into one bundle. My job is to help you think and to maybe consider what the negative effect of not taking advantage of a very clear picture in front of you. To me, the very clear picture: rising commodity prices, raging inflation, detrimental negative effect on other sectors, and how can I move my money to safety and participate in that? The supply chain and the capital chain has been derailed. There's nothing anyone can do for 3 to 6 years. That means we have a wide open runway to take advantage of the current market if we're smart enough to do so. I'm Troy Eckard. I'm the manager and CEO of Eckard Land and Acquisition. Feel free to call me anytime in my office. I look for your comments, and I look for your possibly joining us as a mineral partner in the future. Thank you.